Hi, this is Darren Sang. I'm one of the organizers of the Crypto Symposium. Today, I'm here with Stephen Diehl. Stephen, why don't you introduce yourself?
Hi, so I'm Stephen Diehl. I'm one of the organizers of the Crypto Policy Symposium as well. Um, I'm a software engineer, 15 years working in the financial services sector. I'm the author of the book Popping the Crypto Bubble. I was one of the primary organizers of the congressional letter campaign around crypto policy in the United States Congress. And I've been involved in a lot of grassroots lobbying around crypto assets here in Europe as well. Today, we're going to do a little interview about my perspectives on crypto assets.
So, Stephen, how did you get into crypto criticism?
So I've been aware of crypto ever since the Bitcoin white paper. And I don't think I really took it seriously up until a few years ago when I started to see the impact it started having on my profession and on the world in general. And in particular, I saw sort of the malign influences having on just the disruption of the software industry and the financial services sector, and the risks that these assets were bringing to the public. And that's when I started writing about the risks and concerns I had about crypto on my blog. And ever since then, I've been sort of the go-to person in certain circles for the media to go to get the sort of the contrarian perspective on crypto assets.
So, what led you to organize this conference?
So I gathered up together with a bunch of other crypto skeptics, and we thought it prudent to run a conference where we could bring policymakers together with experts to give a more critical perspective on the cryptocurrency industry, because it's a perspective that you don't otherwise hear otherwise. And we really just wanted to have a set of panels where we'd put together sort of four people who are experts in banking and law and policy, and technology together to hear the kind of the confluence of their unique perspectives. And hopefully that would inform better policy decisions.
You're well known for referring to crypto all as a giant scam. Can you elaborate on why you think that?
So scam is one of those words that's turned around a lot these days, and everything from like, Theranos and Elizabeth Holmes to the Fire Festival. Crypto, broadly speaking, is a family of financial schemes in which most people are guaranteed to lose money. And they lose money based on the material misrepresentation of risks and returns by the promoters of these schemes. All of this damages because the technologies and investments are intentionally set up outside of the regulatory perimeter by the promoters of these schemes to intentionally enrich themselves through market manipulation and information asymmetry. This to me is kind of a textbook scam. The fact that so many people believe in some sort of ideology or vision around the cryptomania is actually immaterial to the simple truth that most people are going to lose money. So in many ways, I see crypto as Silicon Valley's version of a multi-level marketing scheme just put on the internet.
So, the namesake cryptocurrency is often used in the media. Can you elaborate why you think the term is problematic?
I think the term is problematic because crypto assets aren't currencies. They don't meet the economics textbook definition of money, which is a unit of account, a medium of exchange, and a store of value. And crypto assets fail to fulfill the latter two. There's really no formal system that holds together crypto assets. These assets often have a fixed supply and they have variable demand, which means that there's never going to be any kind of level of price stability on them, which makes them absolutely rubbish to use as a mechanism for commerce, right? And these kind of fixed supply or hard money systems, like we've tried in the past with the gold standard, generally lead to really terrible consequences and deflationary spirals. And this is in contrast to kind of the normal central bank fiat system that we've put in place for the last 50 years or so, in which we have a dynamic supply, which is controlled by a central issuer in response to market conditions. And money is created through open market operations and by the central bank, and by commercial bank lending activities. And that system is remarkably robust compared to pretty much every other model that we've used throughout history. It's not perfect, but it works fairly well. And trying to use crypto assets like as money, it just results in like models that we've mostly tossed out throughout history because they don't really work very well. So crypto assets just aren't currencies. And that part of the namesake is, it's really problematic. It's like, yes, you can have square wheels, but they're not the optimal form. And crypto just isn't money.
Got it. Got it. When do you think crypto shifted in terms of a narrative from being a medium of exchange into a speculative instrument?
I'd say around the 2016 era, there was this demographic shift in the crypto ecosystem. In the early Satoshi days, crypto arose out of the kind of the crypto wars of the 1990s, which pitted software engineers against the US government around kind of export controls around cryptography. And it grew out of this sort of like cypherpunk culture of people that really wanted to use, I'd say, cryptography and technology to undermine the state. And these people are actually very sincere. They are deeply libertarian, but they see the world in terms of this like conflict narrative, and their goals are to kind of minimize the state control, which they see as like the state as being invariably tyrannical. And they genuinely believe what they say. They actually argue for these things actually in good faith. What they believe is sometimes a little unhinged, but they really do believe it. And unfortunately, those people kind of disappeared around 2016, and crypto overwhelmingly has kind of become this kind of like crypto bro culture that arose around people that really don't have a coherent ideology, other than maybe sort of extreme laissez-faire capitalism and sort of nihilism, right? They just want to make money and they don't care who gets hurt, right? There's kind of this permanent grifter class that's always existed in technology. And around 2016, as people discovered that they can run initial coin offerings, they can run Ponzi schemes, and like they just care about making money. They don't have an ideology, right? It's just like ideology and technology be damned. They simply don't care about anything other than making money. And that's basically where crypto is today. It's primarily people just interested in cashing out, making more dollars, not so much about sort of old school libertarian ideals.
What do you think happens when you approach them with this contradiction?
Well, at the Crypto Policy Symposium, we actually invited some of these rather sincere cypherpunks to talk about this. And I don't agree with these people on many things, but you can talk to them in good faith and have a conversation about some principles, even if you disagree. And I would invite everybody to look at the Politics of Crypto panel that we did. I thought that was a very insightful conversation between the two different perspectives on this.
Do they recognize that? I mean, you commonly describe it as a Ponzi scheme. Do they think it's fair? Do you think it's fair? What do you think arises out of that?
So this is a perennial question in crypto skepticism. Can we refer to crypto assets as Ponzi schemes? And the answer is, it depends who you ask. If you ask a lawyer, the answer is probably no, because it doesn't fit the sort of legal definition of a Ponzi scheme because there's no central operator. But if you ask an economist, they might say, well, yeah, actually it's kind of a Ponzi scheme because it has exactly the same payout structure as a Ponzi scheme. And a Ponzi scheme, for those who don't know, is a financial scheme where old investors are paid out from new investors. And the thing about this term is that it really is a term of art, right? It didn't exist before we had Charles Ponzi back in the 1920s who ran this scheme, but the Ponzi scheme itself was still prevalent because it's one of those things that's always existed in markets. They arise very naturally out of the fact that oftentimes when you're running an investment fund, right, and you can't make the returns your investors are expecting, it's very easy just to bring in new investors. And people can often run Ponzi schemes sort of accidentally, or they can just arise out of people who are just desperate. And there's an open debate about whether we can call crypto assets Ponzi schemes. I think there's a better term of art that we're probably still searching for. Some people call them like self-assembled Ponzi schemes or headless Ponzi schemes or Nakamoto schemes after the original creator of Bitcoin. But the fundamental truth remains that the payout structure of a crypto scheme is exactly the same as a Ponzi scheme. It pays out old investors from new investors because there's no income in a crypto asset, right? It's not like a stock or a bond that where, you know, there's a claim on the assets of a company or there's like income coming from some productive enterprise. A crypto token, simply has no income, right? Any money that one person makes is exactly the same money that another person's lost. It's a zero-sum game, and the expected return on investing in crypto is strictly negative. Most people will lose money, and you should run away from crypto investments just like you run away from Ponzi schemes because they're economically absurd.
So clearly the economic foundation of cryptocurrency and Ponzi schemes are very shaky. But I think a lot of Ponzi schemes kind of arise from the promise of a return on something, and instead being actually in practice, it's a lie because the return is actually from new investors, right? So there's this fraud mechanic by basically you're lying, you're proposing one thing, you're actually giving another. I think a lot of times with cryptocurrency, they don't propose anything. They just leave it up to the air. Oh, you're just making money. But the underlying economic assumption is what you're saying. It's that the math is that the money comes in and it gets out from new investors. And that's the only way. So although on one hand, they're not necessarily lying, in some places they are, the underlying foundation of economic fraud is still there. With that in mind, what kind of other economic problems do you see with institutional investors treating crypto as an investment? You think it legitimizes them?
Well, the problem with treating crypto as like a new asset class or an investment is it's not an investment. It's the creation of an artificial asset, which has offers no rights or claims on the issuer. It has no income. It has no cash flows. It's a pure greater fool product. The supply is fixed. So crypto is purely a bet on the demand for the asset being driven by an infinite supply of fools in the future, right? This can never be a sustainable long-term investment, right? It's driven only by supply and demand. And since the supply is fixed, you're betting on the fact that there's going to be a demand of irrational actors that will continue buying this thing in perpetuity into the future forever. Crypto is done really just a bet on more fools in the future to buy out your position. And that looks somewhat unsustainable. I mean, if you just look at the price behavior of it, just detached from the underlying reality of the payout structure, right? Crypto is basically just like a high beta risk asset with like an overwhelming correlation to the NASDAQ. So it's unclear what this would actually give you as an institutional investor in terms of your portfolio diversification. And if you want a more detailed kind of analysis about like why crypto really isn't suitable for institutional investors, I would read like Nassim Taleb's Bitcoin Black Paper, in which he derives a fairly compelling argument why crypto assets like Bitcoin should have a fundamental value of 0.
And probably a lot of wash trading in between, which are typically illegal with most securities, traditional securities anyways. Right?
Well, there's all sorts of market manipulation that goes on in the crypto markets, but arguably, since they have no fundamental value, they have no income, all of them are just on some sort of random walk, reverting back to their fundamental value, which is strictly 0.
Speaking of that, why do you think that cryptocurrency fanatics like to call it a hedge against inflation?
So this is one of those perennial narratives that's been around for a long time. And despite all evidence to the contrary, seems to persist. So is crypto a hedge against inflation? No. We see this clearly because in the last 6 months, inflation has risen drastically and Bitcoin has crashed. So as inflation goes up, Bitcoin goes down.
How much is it correlated with the normal risk assets, like the stock market?
Well, it's highly correlated with the NASDAQ, right? So obviously, if the equities market's crashing, right, and Bitcoin is following the NASDAQ, then it's not a hedge against inflation. So the notion that Bitcoin is a hedge against inflation is completely baseless and discredited at this point because it's just math.
I think it was I think someone I spoke to said it's very close to 1-to-1 with NASDAQ actually. So why do some people call it digital gold?
Yeah, this is another one of those perpetual narratives that people like to bring up, and the narratives around crypto change so frequently. These days, it's very popular to refer to like Bitcoin as being like digital gold. Like gold is a very pathological asset in some ways because of its historical quirks, that it was used in banking and issuance of monetary supply a while back. But the Bitcoin store of value thesis is not supported by any evidence. Like the volatility in the market continues to be ridiculously high, and its volatility often rises when the equity market volatility is rising too. It seems to have no correlation with the price behavior of gold, which you're thinking if it's going to behave like gold, it should have some high correlation with gold asset, right? Now, what's true about Bitcoin is that it's a narrative-driven asset, and gold is a very narrative-driven asset as well. Gold has a certain place in American financial markets and American political ideology, where certain people regard it as being a place to, park value as a store against a tyrannical government. And that's always been part of the investment narrative. If gold appears to be a hedge for anything, it's kind of a fear for inflation or a fear of financial instability as proxied by changing government deficits. But gold has sort of a millennia of narrative surrounding its use as a store of value. And most importantly, gold is not a purely narrative-driven asset. Jewelry is still the primary use of gold, and it makes up like 78% of its use on a yearly basis. So unlike crypto, gold is a commodity. It has a physical existence, and it's used in economic input to industrial processes. If people stop believing in gold, like it still continues to exist, like the bars will continue to persist. Like if people stop believing in Bitcoin, it simply ceases to exist because there will be nobody to upkeep the cost on the crypto mining. And if Bitcoin is anything, it's more like a digital pet rock than it is like digital gold. It's a fad.
So the larger question kind of remains in terms of what is it? There's a question about, is it a commodity or not? What are your thoughts on that?
Yeah, this is a perpetual debate, especially in policy at the moment. No, like a commodity is a physical good that's used as the input to some economic process, like wheat, chicken, pork bellies, aluminium are all commodities. Crypto is not, for two obvious reasons related to its supply and demand. Right? The supply for crypto assets is created, I'll use a Latin word, ex nihilo, which means out of nothing. Right? Several developers basically just decide on the parameters for the new coin, just like the founders of a company do when they create the number of shares in a company, right? And they create that financial asset out of nothing. And they're not raising chickens or drilling for petrol or smelting aluminum. Like a crypto asset, just like any other financial asset, is a legal fiction. It exists within a legal framework. And then the demand for crypto does not arise out of any kind of consumptive activity. You can't eat Bitcoin, you can't burn Bitcoin, you can't live in a Bitcoin. All you can do is try to flip it around to a greater fool. Very much like a financial asset, albeit a very pathological financial asset because of the income-free nature of it. So crypto tokens simply are commodities because their supply is not created ex nihilo, and its demand is not given by any consumptive process. So crypto tokens are very much like securities contracts. They're like bonds or stocks, and those are two different things.
Essentially abstract securities, right?
They're securities with no income and don't pay anything out.
Securities, no income, no actual productive value to society. What do you think the role of naked speculation and its relation to crypto is?
So naked speculation refers to the creation of financial assets, which don't give any rights or claims on any incomes or future cash flows and don't pay out any amount of value, right? They exist purely to trade on a speculative basis, right? So naked speculation means you're creating a financial asset whose sole purpose is to flip it around and which represents no claim on anything. So it's really hard to find pure things that are sort of pure naked speculation in the market. But imagine you were to create a shell company that didn't do anything, and then you sold shares in that shell company. Now, the shares in that shell company could have a non-zero market value, but fundamentally, there's no reason that they should have a non-zero market value. And that would be an example of naked speculation, where there's no underlying productive enterprise, there's no rights or claims on any kind of cash flows, there's no income on the underlying asset. People just trade it for the sake of trading it.
So if that's the case, what do you think are kind of comparable assets to crypto? So on one hand, it's kind of fraudulent, it's kind of like a Ponzi scheme. On the other, it's clearly not a commodity or digital gold. But what other kind of things that are out there that are kind of naked speculation instruments or otherwise that are comparable?
Yeah, it's really hard to find comparable assets. So crypto, if I were to describe it in academic terms, is a purely narrative-driven, income-free, speculative asset that imparts no rights or claims on anything. So like in the realm of like fictional finance, you could call it like a zero coupon perpetual bond, basically a piece of paper that trades in perpetuity and doesn't pay a coupon, unlike a normal bond. You could say like, like I gave the example of a shell company. So like shares in the South Sea Company, which is a very famous speculative mania that occurred in the 1720s in London, in a company that originally did trade abroad, but didn't actually have any operations, but there was a large speculative mania around it. And then the other comparable thing, I guess, would be like sports betting here in the UK, where like people wager on the outcomes of a football match. And these are zero-sum bets. You're buying a position on the outcome of a specific event. And the only money that any one winner can make is money that ultimately somebody else has lost through the bookie. And so those are the three kind of pathological edge cases on markets that I would best compare crypto assets to. They're extremely pathological securities, but they are sort of close to income-free financial assets or gambling products.
It's almost like the expectation of hype is what you're betting on for crypto. I think for sports betting is a little slightly different because it's based on a usually case-by-case outcome, right? You watch a game, there's an outcome to the game. So I think that it might be slightly different. I think you're right on the first side, though. I think it's more probably hype driven than anything else. It's like you're betting on, oh, I think there's going to be more hype in this crypto thing where more people are going to get more interested in it, right? Whether it's true or not is another thing altogether. And as a result, there's more greater fools in it, except most of the people don't think about the second side of it. They only think about the hype factor of it. And that's what kind of dictates its expected value or expected supposed value. So what do you think the difference is, like, since it's such an abstract thing like hype, what do you think its relation is with other derivative products? So we talk about commodities, and commodities are very much raw materials, but there's also a lot of abstract securities that are built based on it. Derivative products on like futures and forwards contracts and options contracts based on stocks or raw materials.
So there's a large variety of rather strange derivative products that are offered on the market today. As we saw in 2008, these things can get very, very complicated. So it's true that there are some zero-sum derivative products. So things like cash-settled futures on certain commodities. These are basically investment contracts where the actual underlying commodity is not actually custodied by anybody, and people are taking positions which give them some rights or obligations based on the performance in the market of some underlying commodity, and they're all settled in cash. So these are actually zero-sum contracts that people buy. But the difference is that there's actually an underlying commodity. So these futures often will have like petrol or gold. And there's actually a use for cash-settled derivative contracts because they provide either diversification or ways to hedge your existing portfolio positions. And then there's even more bizarre things in markets. So things like, volatility swaps and derivatives, which use like the VIX index as the underlying benchmark. So VIX is like, it's an index which tracks the implied volatility of the S&P 500. So this is a very abstract thing. The implied volatility is calculated from Black-Scholes. It's a very complicated indicator of the behavior of the options market, and you're like 4 or 5 levels removed from actual companies. But at the underlying stack here, there is actually a real thing that's being traded. There's a real productive enterprise, even if your exposure to it is through 3 or 4 different levels of derivatives and benchmarks, right? And things like interest rate swaps, where you swap one line of cash flow, which is a fixed rate for a variable rate. There used to be some very strange products that were called like turbo swaps back in the 1990s, where they were like interest rate swaps, which were one of the legs of the swap was like the LIBOR rate, which is the London Interbank Exchange rate, like raised to the 3rd power. So it's unclear what kind of LIBOR rate. What purpose that kind of instrument would serve, other than basically taking extremely risky bets on the behavior of LIBOR. So like LIBOR cube swaps look kind of like crypto assets in the sense that there's no actual rationalization why you would ever buy one of these things in your portfolio other than just to like gamble. And then there's things like weather derivatives, which are basically derivatives which pay out based on the behavior of certain weather phenomenon, which people would use, like say if you were investing in like hydroelectric power, right? You might want to buy a weather derivative to diversify your portfolio's exposure in the case of adverse weather effects, which affected the productive assets of your portfolio. So there's actually a use case for some of these things.
I mean, if you're a farmer, it makes sense, right? If you're a massive agriculture company and you need to hedge against certain weather patterns that might affect your crop, it certainly makes sense to buy those derivatives. A lot of times, I think commodity derivatives are based on the fact that on farming, essentially to kind of counteract unexpected things in the market or actual real life weather and physical markets. They create these abstract financial products to protect the underlying farmers and companies in their business. Right.
Derivatives get a
So
bad name, but they actually do provide diversification, optionality, and hedging for institutional investors, and they're kind of very unique exposure needs. Probably not for your average retail investor, but derivatives serve a purpose, and they're very important in
oh yeah,
markets.
absolutely. I think a lot of the energy, the negative energy towards derivatives come from the fact that they're compounded a lot. It goes away from like the base reality of necessity and goes into like what you said, the triple LIBOR swap, which is kind of silly. And also a major cause of the financial crisis in 2008. And with that, I mean, a lot of times, some people, going back to our main topic at hand, a lot of people will you and I talk to a lot of different people in the space, even on the pro side. And some of the arguments they say, oh, when you ask them, hey, what is it backed with? What is the underlying of this crypto asset? They'll say it's the blockchain, right? They'll say it's technology. I'm betting on technology. So what about that? Is that really useful? I mean, I had a conversation the other day with somebody, and the idea that they had could just easily be replaced with a lot less effort with a traditional application stack. So what are your thoughts on that?
Yeah, this is a common meme like, oh, not Bitcoin, but the blockchain is the actual innovation here. The thing is, though, like append-only digital ledgers are not a new idea. We've been able to build these things for like 30 years now. They do have a few applications, but they're so vanishingly small as to be almost inconsequential in the field of software. Like you generally don't want to build append-only data structures because that just doesn't match the needs that most companies actually have. Most companies need to opt out of the append-only part because they need to delete, redact, or update customer data. They also have very complex needs around like access control rules about who can access data and who can update data. And like creating a giant public append-only ledger is just not, is a very blunt solution to a problem that most people don't actually have. And if you happen to add like all the things that actually companies actually need to a blockchain, well, that's a piece of software that we already have. That's called a database with an audit log, right? And there's no reason to call that a blockchain. In fact, when people generally refer to the blockchain, especially in like enterprise context, it doesn't really have any kind of universal meaning. As I found out when I did the congressional letter talking with several hundred computer scientists, and I spoke to a lot of people in our field. And if you talk about what the word blockchain means, you often get down to nobody has any idea if you take it down to like the most basic definition of what the blockchain is. It could be, people refer to SQL databases, which is something we use everywhere in software, as blockchains. And if a word has no universal meaning, then maybe we shouldn't be using that word, because I think it's very problematic.
Well, I understood it was just essentially a data structure and multiple databases speaking to each other to make a cryptographically linked list, right? I mean, maybe you should explain some of that to people that are listening. Maybe not everyone knows what a data structure is.
So a blockchain, in one definition, and there are many of them that I've heard, is a collection of data called like a linked list, which uses something called a hash function to aggregate data in those specific elements in the linked list, such that any one change in any what's called a block before it is reflected in all subsequent blocks. So basically, it's kind of a tamper-proof data structure in which altering any data in the past ultimately alters all data in the future. And so you have this kind of integrity guarantee. So this is something we've known how to build for a very, very long time. We've built tamper-resistant append-only data structures since the 1980s. And they do have some use cases, but the word blockchain is just applied to so many different contexts and so many different things as to be almost meaningless. And while the specific data structure I refer to maybe has some very, very small use cases, it doesn't really match the needs of most corporates. And the overuse of the word blockchain, unfortunately, is a bit problematic, because it tends to be used also in marketing for crypto assets. And oftentimes those two can become muddled and confusing.
So with that, what do you think in terms of like the financial services sector, where they think that blockchain could be a better solution compared to a traditional database? Because we've seen definitely certain companies out there that like in the banking sector that kind of try to attempt to work together to create a blockchain, if you will.
Yeah, just last week I saw the Wall Street Journal run an article about how Goldman Sachs is going to be using the blockchain to revolutionize all of its back office processing or
We
something.
heard that with JP
And
Morgan.
people have been trying this for, oh, I'd say 5 or 6 years now. There have been a lot of prototypes, proof of concepts, and many projects have tried to use the blockchain, which is really much kind of a solution in search of a problem. And most of these projects have failed. People try to use them in settlement and clearing systems, in real-time payments, in remittances, in reconciliation, in corporate treasury, supply chain and inventory management. And it just turns out that like the blockchain just isn't that useful in practice. Most of the time you could achieve everything you wanted to do with a normal traditional database. And that just meets the needs of corporates a lot easier. And so it's unclear what the blockchain is really bringing to financial services that you could not do better with existing and more mature technologies.
I mean, I think there's a significant gap with people who understand finance and deep finance, as well as tech and more deeper tech, and then relating those across is quite difficult. So a lot of times people who work in the financial sector may not necessarily understand technology to that level and latch on to the popularity of that term. What do you think it does in terms of blockchain? I've been asked this question, you have too, in terms of solving the concept of trust.
Yeah, I've often heard this phrase used in like business books and like in talks about the transformative and paradigm shifting power of blockchain to solve trust, whatever that means.
Through verification, right? Through verification. That's also another one that gets thrown around with it.
There's a lot of hand waving around this like solving of trust. No, like blockchains don't solve trust. Like they still suffer from the same problem that databases have. If you put garbage in, you get garbage out, right? If you put crap data on the blockchain, you get crap data out, right? You still need to trust the people putting data on the chain. An immutable log of corrupt data is still corrupt, right? Trust is the foundation of all civilization and commerce, and technology can't fix social problems. So anybody that tells you that blockchain has somehow solved trust, or is like a trust machine, or the ability for to create trust between untrusted parties is selling something, shall we say?
They're untrustworthy.
Yes, exactly.
What do you think happened in 2022 that led to crypto markets collapsing quite a bit, and what they call crypto winter?
Yeah, so what we saw this year was sort of like a mini version of 2008 happening within the confines of the crypto market. It wasn't quite as systemic to the global economy as 2008, but nonetheless, you saw the market crash significantly since its all-time highs earlier this year. That was predicated upon this really catastrophic collapse, which is the Terra Luna stablecoin, which was a project which was allegedly issuing a one-to-one pegged dollar token, which was backed by some rather dubious economics, and it crashed basically to zero. And that wiped out, I think, around $50 billion of asset value almost in the span of 24 hours, which is unprecedented. That quickly led to some knock-on effects in the crypto economy, which is like several other lending platforms like Celsius and Voyager experienced what are pretty traditional bank runs. Turns out these entities were kind of acting as they were taking customer money as unsecured creditors. So you're giving money to this sort of quasi bank, and they were basically taking that money and putting it into extremely risky positions like a hedge fund and promising things like 18% yields, which is like—
That's called DeFi, right? That's called DeFi.
That's called DeFi,
right?
Yeah.
Highly leveraged bets.
Highly leveraged bets. So you have this sort of quasi bank with a hedge fund on the back end, and it turns out, well, that's not a really great idea, and that basically fell apart. And now a lot of retail investors have lost a lot of money because they were seduced by these like 18% returns, which are entirely unreasonable. It's like Ponzi scheme level returns. And then there was a few other knock-on effects like this Three Arrows Capital in Singapore, which was like a counterparty to a lot of these other platforms, and they went bust, and the founders basically just disappeared. And this all looks really shady, and it's like a mini version of like Lehman Brothers collapsing in crypto, and that has destroyed a lot of trust in the ecosystem, and it's caused a lot of regulators to start looking into maybe this whole thing is like a house of cards, and that's reflected in the collapse of the market.
You mentioned this. There's I think it was either yesterday or today that North or South Korea actually has an arrest warrant out for Do Kwon, which is the creator of I think Terra Luna, right? So yeah, it's definitely consequences, especially when you start taking people's money in custody and then misusing it towards highly leveraged bets on derivative securities, which essentially DeFi is, right? What do you think some of the problems are with crypto exchanges?
So crypto exchanges are basically like a vertically integrated exchange, market maker, clearinghouse, broker dealer, and prop trading firm all in one entity. So that's a vast array of like conflicts of interest that give the exchange vast information asymmetries, which they can use to enrich themselves on behalf of their customers. So that introduces a lot of conflicts of interest. So exchanges, especially the ones set up outside the United States, can do things like front running, wash trading, painting the tape, order spoofing, basically everything that's been illegal in normal markets for the last 80, 90 years because there's no regulation.
Right.
And when you take other people's money and you can run a manipulated market, that's a really lucrative business, but it also creates kind of what economists call like a market for lemons, which destroys trust in markets. And it's just antithetical to capital formation. And that's the big problem I see with crypto exchanges. These things are set up in offshore tax shelters. They're engaging in some rather shady behavior, and the markets themselves are deeply manipulated and opaque. And really, there's a reason that we create regulation around in separation of concerns around these entities, because if you put them all together in one vertically integrated stack, it just gives one entity too much power, especially when they're handling other people's money.
In a way, you could say they're centralized in a way to misuse power, right?
They're very much similar to say the bucket shops that we saw in the 1920s, which were.
So maybe you should explain bucket shops to those who might not know what these are.
So bucket shops were sort of quasi-broker dealers that existed in the 1920s, where people would invest money in a broker, which would allegedly execute positions on the market, except oftentimes they wouldn't actually execute the positions in the market. They would just give you a quote on the market price, and they would basically just like running sort of a quasi-Ponzi scheme where they're paying out investors who wanted to withdraw the money from the bucket shop from other investors that they brought in to allegedly invest in stocks. And so they're basically running like a quasi broker without the execution, and running kind of a sort of quasi Ponzi scheme where they would just shuffle money between different individuals who wanted to withdraw it.
Going back to when exchanges are considered centralized, a lot of pro crypto people will tell me they're decentralized because they're set up in smart contracts to do the actual exchange. So what are smart contracts, and why are they so problematic? Not even just in the exchange sense, but in the actual in the actual definition and what it's composed of.
So smart contracts are this idea that you can put like computer code, like programmable logic, on the blockchain, and that can mediate the value of the crypto tokens native to that chain. So allegedly, you could do things like running like an escrow service, or like a where multiple people have to sign off to authorize funds. But in practice, people are trying to write very, very complicated sets of logic that can build sort of things like decentralized exchanges or like gambling platforms or all manner of things, except that like smart contracts are a really terrible idea. The notion that like what's called code is law assumes the capacity of software engineers to like completely encapsulate user intent into program logic. And we don't really know how to do that yet. It's a really, really hard problem in computer science to verify software and verify that software actually matches the intent of the programmer and the end users itself. And it's really hard to write bug-free code. And since the smart contract is deployed on an immutable ledger with irreversible transactions, this leads to a lot of catastrophes. it turns out in financial services, you almost always want a human in the loop in the case of kind of bizarre externalities where there's programs where there's conflicts between users and the issuers of the contract. And publicly hackable, irreversible transactions attached to buggy smart contract code is the recipe for absolute disaster. And that's why what you hear in the news, like every other week, one of these things explodes and some hacker runs off with, $100 million in smart contract funds. They're just a cybersecurity disaster. And just like this notion that like you lose your keys, you lose your funds, they're just simply a bad architecture. Like you just don't want to build a system on top of this because it's not a system that you can build an economy on, because the average user can't look at smart contract code and determine the risk associated with these things. And you really want humans involved to kind of check and reverse transactions in the case of externalities.
Wouldn't you also say some of these, could you speak more about even some of the languages and how they're, because when you look at law and you say, let's say you look at smart contracts, let's say there's a real thing called smart contracts and you talk about law, right? And the language in law, legalese, matters because how you write the law, how you speak about something in the law dictates how the courts and how people will deal with what is written. So if you take that same kind of concept and bring it to code, what arises out of that with smart contract languages that can be problematic?
Yeah, so contracts, as they're defined like common law, or they're offer and acceptance between two people about some written set of terms, which is written in language, a specific type of language called legalese, which is interpreted in the minds of humans. And oftentimes it's ambiguous and it exists in a context of precedent, which basically is the interpretation of the law in terms of how everybody else has read it in the past, right? And like in Britain, we have common law, which is goes back to the Middle Ages, and it's like 1,000 years of precedent about how people interact, what's fair, how we denominate contracts, like how value is exchanged between people, and when we trust each other, and when we kind of resolve disputes in fair ways. And the fact that we can use the courts to interpret the cases where the law is ambiguous is a feature, not a bug. And in the case where you have the unhappy path of a contract, you always want to have a human involved to basically determine what should be the outcome, because there's no a priori way that you can decide this just independent of the conditions of the humans involved. There's always some discretion involved in these things because humans are messy.
And in terms of the actual contract itself, and not in the legal sense, but in the language form of the programming language of the smart contract, aren't there parallels to how the language is constructed, and it's constructed poorly so that there's accidents that can arise from it?
Yeah, so on the Ethereum blockchain, for instance, there's a language called Solidity, which, to put it bluntly, is a language which makes other poorly designed languages look like a work of genius. It's a language with what we call very loose semantics. It admits a lot of, shall we say, undefined behavior, and it's very, very hard to write correct code by construction. It's designed to resemble languages like JavaScript, which optimize for being very, very easy to get into, but very hard to make, to verify that the integrity of the code is correct. And unfortunately, the designers of the Ethereum blockchain chose a very poor paradigm to write smart contracts in. And that unfortunately has led to a lot of disasters simply from a pure software engineering perspective. And that's unfortunate because a lot of these things could be prevented. But this goes back to the fundamental idea that just smart contracts, publicly hackable code with irreversible transactions, it's just a really bad design. Right, we shouldn't be doing this. So no amount of technical solutions is ever going to fix Solidity, because the entire fundamental idea is just a really bad idea.
So going back to maybe the concept of blockchain being of a public blockchain being a public database, what do you think about financial transactions being publicly made available so people can verify it?
It's a bad design as well. Financial transactions need to be private by default because they contain potentially personally or commercially identifiable data. So imagine we go out to the pub with your mates and you want to split the tab, right? Me splitting the tab basically involves me handing over all of my financial history to my other counterparties. That's a terrible design. That's not how the financial system should work. It's just fundamentally broken by design. And that arises out of the sort of like quasi-libertarian roots that were baked into the Bitcoin design, because they wanted to create this, global ledger. And it's just not a great idea. Like, and then fundamentally the idea, like, if you lose your keys to your wallet, right, you lose your funds. That's a bad design. It's broken. It's just fundamentally against, the intent of the user. Nobody will ever use a system like that at scale. Like, you can never get your grandmother to self-custody the cryptographic keys for her wallet. And so, or you'd basically just hand it over to a centralized party, at which point then you've recreated what we already do. So the design of publicly accessible data, in which basically in order for you to pay anybody, you to completely dox yourself, is just broken by design. We shouldn't use it.
Yeah, I mean, it seems like a lot of this stuff is driven a lot by like ideology, like anarchist libertarian ideology, like the whole like your keys, your bank kind of thing. And maybe a lot of people don't really understand that there's a lot of consequences to that, and a lot of secondary externalities that maybe I shouldn't have to manage my own keys, and maybe I can lose my password and get it fixed. So, I mean, with that in mind, there's a lot of similarities in that crypto ideology space with, and not just libertarian ideals, but like also cult groups like QAnon and flat earthers. What are the comparisons so prevalent, you think?
Yeah, so this is something you often hear in the media quite a bit. The Financial Times did a really great piece called "The Cult of Crypto," in which they outline, and I'll say this, it's a subset of the people involved in crypto. A lot of them simply don't have an ideology at all. They're just in it to make money. But some of the true believers in crypto have some very strange beliefs that border on what I would call like a secular religion. And the word cult has a somewhat pejorative use to it. And there, cults are a spectrum. And there's kind of good cults and there's bad cults, right? On the bad cult side, you have things like, like Heaven's Gate and Scientology and that. And then on the good cult, you have things like, I don't know, like the exercise cults, where people like, they all use strange language and meet up every week and they all work out and get in shape. Like the ultimate result of those is that people get in shape. Or things like, some nonprofit organizations where like, we're going to go raise money for cancer. And like they have very sort of cult-like language, but they're actually ultimately a good force in the world. But cults are defined by a certain set of social behavior, which kind of tends to separate people into kind of in groups and out groups. They tend to have this notion of like milieu control, where basically, we keep members in the group through sort of coercive practices. They often sort of warp and distort language, so they invent their own sort of like in speak, where they like reinvent words and change the definitions of words so they mean something different than the out group. They often have a sort of charismatic leader, or sort of a quasi-messianic figure, sort of like like the Bitcoin Nakamoto that kind of disappeared, or maybe it's some sort of like stole fire from the gods and or sacrificed himself for the greater cause. And they oftentimes have an eschatology, so some sort of like predicted end day, where some sort of cataclysmic event is going to happen, and the true believer is going to be reborn in some new, better version of the world that they're trying to build.
They go to the moon. Everyone gets a
go to the moon, or the end of the dollar is this kind of eschatology.
That's the cataclysm kind of thing.
The hyper Bitcoinization. Yeah. And then the most defining feature is this thought terminating cliches, which are these basically phrases that people repeat to quell any kind of dissent. Like, oh, not going to make it, have fun staying poor, like all of the ones I hear all the time.
This is good for Bitcoin. This is good for Bitcoin.
This is good for Bitcoin, because everything's good for Bitcoin, right?
Yeah, that's very good. One of those,
or like Satoshi, he's had this phrase, it's like, if you don't understand it, I don't have time to explain it to you. It's these weird distortions of language, and anytime anybody has any kind of rational arguments against some aspect of the crypto ideology, there's always a response to it, which is always a a short cliche, like, oh, well, you just don't understand, or you're not going to make it.
Oh, there's
And
few understand. It's not you don't understand. It's few
you
understand.
understand. There's a whole
Because they're
list
a
of them.
separate group, right?
Yeah, whole
So then,
acronyms that all reinvent language. That's very cult-like.
so the
And
narrative. Sorry, go ahead.
And the most important thing is if you contradict the orthodoxy, you face ostracism from the community, because the returns on a purely narrative-driven asset come only from recruiting more true believers into the scheme. You need to increase the supply of fools. And that's where the cult-like mentality synergizes with the financial aspect of crypto to give rise to what I consider a very sort of toxic reinterpretation of the word community to basically be a means to generate exit liquidity for the early bag holders. Yeah.
So the narrative behind this crypto ideology seems to be really rooted in anti-democratic and distrust of institutions. Can you expand on why this narrative is so appealing at this point in time?
I think a lot of it arises out of 2008 and the global financial crisis. The banks crashed the global economy in 2008 and no one went to jail. President Obama decided to bail them out in exchange for taking risks with the public money. All of the bankers got bonuses. It's a classic example of moral hazard, and people should be legitimately angry and demand reform. And that manifests in a lot of the Bitcoin ideology. Some of these people feel like the system is fundamentally broken and can't be fixed, and we need to burn everything down. And like a phoenix, like a new, less corrupt system will rise out of it. And it's a lot of the same sentiments that you saw in kind of Occupy Wall Street about like 10 years ago. But imagine if the Occupy Wall Street movement became corrupted by financialization, and imagine if all of the protesters suddenly became like hedge fund traders. So in some sense, crypto has morphed into the very apotheosis of the corruption it was originally born out of in 2008. And somehow it's even become even more corrupt than Wall Street.
What do you think in terms of, recently there's a lot of stuff around environmental mining effects of crypto and Bitcoin. Recently, there was a merge with Ethereum in terms of making it so it's proof of stake instead of proof of work. Why do you think mining is so destructive?
Yeah, in particular, Bitcoin mining, and Bitcoin's very calcified in its design. So it's by design, it uses this algorithm called proof of work, in which basically computers around the world race to waste energy to basically run this global lottery, decide who can confirm the next block in the blockchain. And the amount of energy use this uses is absolutely staggering. I think it's around 130 terawatt hours annually, or like roughly the equivalent of the entire energy use of Norway. It uses something like 70 megatons of CO2 annually. It's the equivalent power consumption of like the US average household over 47 days for a single transaction. Or to put that in other terms, like imagine if you ordered a hamburger from New York, and the equivalent energy to pay for that hamburger using Bitcoin would be the equivalent to putting it in a Tesla and driving it across the entire continental United States twice for a single transaction. And then on top of that, you have the electronic waste of Bitcoin mining, which basically all these mining rigs, they involve graphics cards or ASIC chips, which basically burn out over time. And so the average cost of a single Bitcoin transaction is the equivalent to like smashing 2 iPhones just to run the lottery system. So people will do all these sort of weird mental gymnastics about how this energy waste is actually a good thing, and that somehow wasting energy like this through some sort of hand wavy appeals to the free market or incentivization structures will actually create more green economy. And they're all bullshit. None of it actually makes any sense. There's no rationale for wasting energy this way when it could be put to far better uses in the economy. And the energy waste of things like Bitcoin mining should make the public angry because they're absolutely absurd.
It sounds like a lot of people they're going after in terms of using these kind of statements, like saying, "Oh, it's digital energy" or whatever. Or people don't. They're trying to manipulate people in the public that don't understand the basics of electricity and energy.
Yeah,
I mean, those are the only people that could possibly fall for this kind of those kind of statements. It's often times that crypto is used as a way to financially include people and a way to increase access to financial services, especially in like minority communities. While at the same time, a lot of critics claim that it's a form of predatory inclusion. Can you speak to the distinction between the two?
Absolutely. So predatory inclusion is the process of giving people that are otherwise marginalized and excluded from the financial system access to services which initially present as a means for inclusion, but they often hide obscured risks and fees or ways of extracting money out of these marginalized groups that are not apparent. So things like check cashing services and payday loans and buy now, pay later services are oftentimes sold to the public as a way of increasing financial inclusion, but in practice, they're actually far riskier than traditional services. And so crypto is often heralded as a way of like building generational wealth for marginalized communities that have been otherwise like excluded from the real estate markets or the stock market. But the reality is that crypto is effectively just a zero-sum game in which a bunch of very poor and desperate people are basically gambling against each other on an ever decreasing share of a manipulated market. And it's just a scam, unfortunately. And wrapping it in this financial inclusion language is deeply problematic because oftentimes these are the people that are least able to absorb the risks possible, and they shouldn't be putting their money in what can most generously be described as one of the most risky assets possible, and in most cases is a scam.
So, Stephen, ideas like NFTs are often heralded as innovation in crypto. Can you talk about what NFTs are and why the market mania around them exists?
So NFTs are actually really as stupid as they appear. They're basically ways of selling links to images on the web. People sell as what economists call like a Veblen good. Like they're basically a pseudo luxury item, except you're not actually buying anything. You're buying basically the equivalent of somebody putting your name in like a star database and saying, oh, this star is named after you. So it's like a very expensive entry in a spreadsheet. And the problem with NFTs is that basically, just like the ICO bubble in 2016, where people were raising money by selling shares in a company, now they're basically raising money into common enterprise by selling shares in NFTs, and exactly the same rhetoric attached to these things. So basically, NFTs are the new ICOs.
It's interesting about NFTs and ICOs. It's funny because when I talk to people about that, they say it's part of Web3. What is Web3? Because I've heard so many different definitions, and I don't agree with any of them, but that's my opinion. What is yours?
Yeah, Web3 is one of those words that doesn't really have any universal meaning. It is a rebranding of cryptocurrency. So cryptocurrency has a negative connotation attached to it. So people invented a new word called Web3, which feeds into this sort of new internet false narrative that people try to push around crypto, presented this as much like the next iteration of the internet. Web3 has no universal meaning in software engineering, and most people consider it a meaningless buzzword. And anytime you hear the word Web3, you should replace it with cryptocurrency.
So it's good. It's good that you said that, because I heard someone online on LinkedIn, and they were generally very negative towards certain VC firms that push the whole Web3 narrative, as they themselves thought it was more about new kind of business models that involve kind of shared ownership and shared benefits and democratization of the underlying organization or project or whatever, right? But I mean, a lot of the times, really, what it is, it's kind of a financialization of every step, every gate, kind of loot box and everything out there. What is this ideology, and what would it entail for kind of the crypto vision of this internet or the metaverse, right? Whatever that is.
Yeah, I mean, if we accept some of these investor theses at their face value, their stated goal is the financialization of everything on the internet. So every single human interaction, every tweet, every like, every YouTube video basically becomes a financial transaction between you and the issuer. And they're all done in this bespoke currency of the platform. So you'd have to have a Twitter token and a Facebook token and an Amazon token instead of simply transacting in dollars. And it turns out these companies will actually issue these tokens as a way of raising money in their platform, just like they would issue equity. And so basically every single thing becomes a combination of like loot boxes and microtransactions. So taking the worst parts of gaming and applying it to every aspect of the internet to turn everything into a transaction. And for some people, that seems like a utopia if you're the one, collecting rent on these transactions. But for most people, that looks like a dystopian version of the internet.
So I've with that in mind, there's a lot of conversation around metaverses, and at least for me, a lot of it seems like they're taking a word that and labeling something that kind of already existed, except it's combined with, so like, certain games like Roblox, which are very popular now, and Minecraft, you could consider the metaverses. But it seems like the new version of that is taking crypto and NFTs and combining it with the concept of VR gaming and in-world kind of things. What do you think about that? Is it kind of, again, the financialization, or they're really just trying to throw stuff against the wall and see what sticks at this point?
Yeah, I'll quote famous crypto critic David Gerard and say, the metaverse is basically like World of Warcraft or Second Life attached to penny stock fraud. So, instead of paying for things in Warcraft gold, now there's a speculative commodity that you're going to, speculative security that you're going to trade, and that's going to be used in the game. That doesn't sound fun to me. This sounds like taking the worst parts of the risky parts of the market and putting it in the game. And I don't understand why people see the metaverse, whatever that means, as being any kind but simply a rebranding of virtual reality attached to some financial schemes.
So there's also another concept, and this is more on back to the kind of finance side and less on the VR la-da-da of NFTs and Web3 and metaverse. And it goes into the issue of stable coins. What are stable coins, and what are the problems they allege to solve?
So stablecoins, unlike the rest of crypto assets, like say Bitcoin and Dogecoin, are crypto assets that are allegedly pegged one-to-one to a national currency like the dollar or the euro. So ideally, you give one of these issuers of the stablecoin $1, and they give you one token, which is allegedly redeemable back for $1. In practice, what they actually act like is sort of like a quasi bank account, but with the reserves for the bank being unknown and there being no regulation or deposit insurance. And stablecoins exist because many of these exchanges, which are set up in like tax shelters in the Caribbean or the Cayman Islands, basically can't get access to traditional banking services because what they're doing is either illegal or a lot of banks won't touch them because their compliance department won't let them handle these kind of transactions. And so what they need is basically like something that looks like a dollar that they can offer to their customers to onboard funds outside of the regular banking system. And so things like stablecoins basically act like casino tokens for people to onboard their dollars and then basically move them to the offshore casinos, and then allegedly they can take them out. So stablecoins are really problematic because they're basically large black boxes of unknown risk set up in God knows where the people investing in them have no guarantees about the underlying assets. And so in some ways they look like a money market mutual fund. And they're just extremely risky product that it's unclear why in the presence of traditional payment rails these things should even exist, except to fund offshore crypto exchanges.
So essentially it's kind of like private money issuance, and it just in a new way. But I mean, historically speaking, there's a lot of stuff in American history, especially around the wildcat banking era. Can you speak to the similarities to crypto?
Yeah, so this idea of private money issuance is actually not new. So in the late 1800s, the Americans actually experimented with a system where there was actually no national dollar. There were banknotes which were issued by banks all across the United States at the time, and every single bank issued its own banknotes. And they would be redeemable within the local jurisdiction, but also with each other. So there was this entire network of like foreign exchange, or what we call foreign exchange now, where people would trade banknotes. And like when the most popular one was called like the Dixie note, which was available in like the South of the United States. And it turns out this is a really, really rubbish model because you really want commerce to be as seamless as possible, and having to exchange your banknotes, make change, and n number of different private monies is just really not good for commerce. And a lot of these banks oftentimes have the same problem that stablecoins has, is like the reserves for the bank were often unknown. They would often just shuffle around like cases of gold and silver between the banks to kind of appease the auditors for the bank. And oftentimes when people would actually go to redeem them, because actually at the time money was actually backed by physical commodities, the bank wouldn't actually have the actual reserves, and so they would have a bank run. And so private money issuance is never a good idea, because it turns out when you give people the capacity to print their own private money, they usually use it for fraud, and the system is just not very stable or conducive to wide-scale commerce.
How did that era end?
So it ended with the Civil War, where to actually fund the Union, basically they created something called the greenback, which was basically the first national version of the dollar. And it turns out the greenback was actually a far superior form of commerce than all these like patchwork of private money issued by all of these banks. And it turns out there was an act passed in the late 1800s that basically made the greenback have special preferential treatment across the entire United States. And then banks were slowly disincentivized from issuing their own banknotes, and the dollar became supreme across the nation. That's what we use today.
It must have been a little bit of a debate back then, but hastened by a war. Right now, we have a debate right now with a lot of U.S. institutions around U.S. regulators around the classification of crypto assets as either commodities or securities. What is the distinction, and what category do you think they should fall under?
Yeah, so this is the debate right now that the American regulators are having. And I think it's been pretty much solved. I mean, the SEC has been very clear that crypto assets are securities. And that test for what is a security is defined by the Supreme Court in a very landmark case called Howey versus SEC, which is originally about orange groves, actually, but it basically set the precedent for determining when an investment contract is a security. And there are 4 prongs of the Howey test. So an investment is a security when it's an investment of money in a common enterprise with the expectation of profit to be derived from the efforts of others. So those are called the 4 prongs of the Howey test. And if you go through crypto, it's an investment of money, check. In a common enterprise, check. With the expectation of profit, check. To be derived from the efforts of others, check. So crypto is clearly a security. There's the common enterprise is the developers basically issuing the token, because in all these projects, there's clearly a core set of developers that issue the token, they promote it, and there's very little distinction between that and another, like a traditional company. So despite what the crypto industry says, they don't really like this ruling, but there is regulatory certainty now. Crypto assets are securities, and they're going to be brought within the regulatory perimeter by hook or by crook.
Probably by hook, right? And they'll be the crooks. What's the difference between in the press in terms of mainstream news outlets like a Wall Street Journal and Financial Times versus kind of crypto outlets like, well, I'm not going to mention them, but you know who they are.
Yeah, there's a very different standard of journalism that goes on in, say, like the Wall Street Journal and the Financial Times compared to things like several of the other crypto press outlets. Number one is that the journalists involved in the reporting generally can't hold the assets that they report on, or they can't hold them directly, right? So if I'm writing about Apple, I can't be promoting Apple and then like unloading shares right before I write my article, right? That would be a conflict of interest. And these outlets have been around for almost 100 years now, and they have a well-established code of ethics around reporting on these things. And the information they report on is, it's the first rough draft of history, and it's generally to a very high degree of standard. Versus the crypto outlets are usually owned by, crypto exchanges, often owned by hedge funds. And the crypto press basically just talks the books of whoever their owners are and promotes these assets without any disclosures. And The reporting is often very biased and very, very pro-crypto, and doesn't present a very objective view about the risks involved with these assets. So we should take what they say with a very large grain of salt.
Or yeah, cool. If crypto assets are so problematic, why do you think there's so much interest from the venture capitalists in the space?
Well, you have to understand the incentives of venture capitalists. They're a business just like anybody else, and they're in the business of taking money from what are called limited partners. They take the money and they invest it in early ventures, which they hope are going to like return money to their LPs, right? And like the venture rate of return to be considered like a successful fund is like you have to like 3x the money of your LPs. And it turns out there's like fewer and fewer things these days that can actually kind of return that rate. In the era of like cloud computing, there was a lot of growth in very, very low cost businesses that could have parabolic returns. But unfortunately, these days, we're often limited in building software solutions, and we're often building physical things now. We're building, actual services for actual people rather than things like social networks. And venture capitalists are interested in crypto because it's one of the few things, because of the unregulated nature of it, that can actually return the fund. And if you think of things like NFT projects, they're very, very low cost. Like you can write a $1 million check to an NFT project, and that can very easily make $10 million and return your fund, because these things can sell for extremely high multiples when you can do the kind of market manipulations that are involved with NFTs. And it turns out these kind of like pump and dump schemes are very profitable if you can get on the right side of them. And when they have very, very low cost for entry, it turns out from a venture perspective, the risk adjusted return on these things is actually pretty good. And what's happening these days is that some venture capitalists have determined that basically instead of investing in equity in companies, you can get the company to basically issue tokens as a proxy for equity. And those tokens, unlike security or like normal equity, are immediately liquid. So you can dump them on the public immediately. So imagine like having an early stage venture, which has no product, no customers, no revenue, but the token can be trading at 100,000 times the revenue of the company, and that can be sold directly to the public. So imagine if like Theranos was able to basically offer a token like 6 months after they were founded, and people could speculate on this token as proxy for equity in Theranos, completely detached from Theranos being a complete fraud. And to me, most of what's happening in the crypto space is people basically dumping sort of Theranos style equity on the public. And it turns out the public likes to gamble on the token detached from the underlying business. And that's a really great way for some venture capitalists to make money. But it's a way they don't want to really talk about because it looks pretty shady.
I mean, you look at a lot of what they say versus what they do. A lot of it's like, in the general startup space is about making the world better. And if you look at normal functioning capitalism and democracy, typically capital goes towards companies that do something productive for society. Yeah. Why do you think, and now you have this kind of shift change where all these VC, well, not all of them, but some of them are kind of leaning towards these kind of deals where they can just kind of put money in and get capital out, but they have no concerns about how productive it is to society. They might just say that, right? We have situations right now around what's that gaming company, Axie Infinity, where an entire country of people were playing that game, but then immediately it's not doing so well. I think it's like 90% down, right? And yes, the game works, but does it actually make the world better when VCs can just put money in and get out? And what is this capital destruction?
Fundamentally, if you look at it from a macroeconomic perspective, like I can't blame the LP or the venture capitalists for wanting to return their funds. That's what they exist to do. That's just their fiduciary obligation. They exist to make money, take money from LPs, and they have to, create a multiple on that. But at the same time, there's a massive societal opportunity cost when, this amount of venture capital money is going into things that basically look like, pyramid schemes, sort of flagrant pump and dump schemes, and Potemkin villages attached to securities fraud. And it's unclear what this is going to do to American capital markets when you have an entire generation of entrepreneurs that are building Potemkin villages that exist purely to pump the value of a speculative asset and then exit as quickly as possible. That's not going to produce next generation of Microsofts and Googles and Amazons. It's going to produce a new generation of Fire Festival, Theranos, and WeWorks at best. And that's going to have,
sorry, go on.
That's going to have a really knock-on effect to the entire economy, because like all of the companies that could have been built are simply not going to get built because it was more expedient to invest in this token scheme where there's, immediate liquidity, no lockup period, and the investors can exit as quick as possible, and nothing actually ever gets built because it's a Potemkin village.
You're almost alluding to, I think, the destruction of productivity and the destruction of productive capital. Because as you put money in these enterprises that return so quickly, but with no actual societal benefit, that's definitely destructive to productivity. But two, it's the opportunity cost of that original capital going towards a company that could have built something that is good for society. So you almost have this double effect where you're making gains for nothing. And those gains, they can't come from nothing. No, there is a consequence to them in the greater realm. For example, if you look at engineering and software, what do you think it's doing to that in terms of the incentive structure for startups founders as well as the profession of software engineers?
So like running a software startup is actually really, really hard. Like startups are one of the hardest things you can possibly do in a professional career. And it turns out if you give like 20 somethings the opportunity to skip the hard part of actually running the startup and actually building something, and the opportunity to make a life-changing amount of money, the only catch is that you basically have to do securities fraud. A lot of like naive 20 something is going to say, well, I'm just going to do the securities fraud. And that's why these token schemes are kind of like securities fraud by proxy, because the venture capitalists are going off and finding a bunch of 20 something entrepreneurs and saying, go run a Potemkin village, just give me a bunch of pre-mined tokens, and I'm going to sell them at some point and just don't ask when. And this, creates a way for the venture fund to make, eye-watering amounts of money, ultimately on the back of the public retail bag holders. And it makes the founders, a large chunk of money, which could be life-changing for them. And they don't actually have to build anything. And at least in America, there's very little risk to the venture capitalists at all, because they're not liable for the actions of the founders. And for the founders, right, you just have to not be the biggest nail sticking out for the regulators to go off of, because regulators only go after kind of the most egregious cases. And this entire system looks kind of like a distributed denial of service attack on securities regulation, where everybody's just running securities fraud left and right because everybody just wants to make money without actually doing anything. And ultimately what this is an enormous opportunity cost for the entire economy and a wealth transfer from the public, the people that are speculating on these tokens, and maybe even some institutional investors, from the public to the investors and founders while nothing is being built. And ultimately, that's only going to create an entire generation of sort of Fire Festivals and Theranos style firms. And that's deeply problematic.
Well, clearly, there's a lot of fraud in the crypto space. Do you think this is going to continue? I mean, there's other things too, like there's things like ransomware out there, which is just blatant. It's not even fraud, but it's just blatant kind of hacking and locking your computer. Why do you think it's kind of ransomware specifically like become more severe and more frequent?
Ransomware has exploded because of one thing, because of Bitcoin. So it turns out when you can create malicious software which locks people's computers and then demands a ransom of arbitrary size, the only mechanism that exists to pay that is basically crypto assets, namely Bitcoin usually. Like if you try to go to your bank and wire money to some, criminal in Siberia that's demanding money, your bank simply won't let you do that, right? By design. Paying a ransom in cash, for instance, you're limited by how much you can actually physically transport in like a suitcase without triggering like suspicious activity reports by withdrawing that kind of money. So there's a fundamental limitation on how much you can actually extort out of somebody in the traditional financial system. But with crypto, you've created this channel for basically funneling arbitrary amounts of asset values to anonymous strangers. And what will that be used for? Well, of course, it'll be used for crime. And the explosion of ransomware we've seen, things like hacking of hospitals and schools and all these horrible, horrible things is enabled exclusively because of Bitcoin. And this is a bad design. You want to have intermediaries that can reverse transactions in the case of extortion or fraud, because like if you create these channels for dark money flows, they'll be used for criminality.
Speaking of dark money flows, Bloomberg reported that the crypto industry lobbying expenses exceeded the defense sector this year. Why is the crypto industry spending so much to influence Congress? And what does that say about the current regulatory environment?
Yeah, so there's an obscene amount of money being spent to influence Washington, D.C. from the crypto industry. It exceeds the entire military industrial complex at this point. They desperately want to choose their own regulators and write their own regulations. And in America, a lot of times legislation can actually be bought and sold through the use of lobbyists and campaign donations. And right now, the crypto industry sees the CFTC, the Commodities and Future Trading Commission, as the regulator of choice because they would be the softest touch. So all of the consumer protections and disclosures around securities would not be present if they had the CFTC as the regulator. And the CFTC, I think, has 1/10 the budget of the SEC. So obviously, for their own rational self-interest, they really desperately need the CFTC to be their regulator. And unfortunately, that puts the public deeply at risk because the CFTC is definitely not prepared to regulate a market as complex as crypto. And it's unclear if the classification of crypto as securities is simply not correct, right? These are not wheat products. They're not petrol.
Commodities. Yeah.
Yeah, crypto is a security, not a commodity. So it's not fit.
What do you think the long-term consequences are if they do regulate it as commodities and not securities?
If the CFTC has remit over crypto assets,
declared them as commodities, and has control over regulatory and enforcement.
There's going to be almost no disclosures. A lot of these exchanges would be classified as automated trading platforms. So the consumer protections around things like front running, market manipulation, painting the tape, wash trading, simply aren't present in that kind of regulatory regime. And which means a lot of consumers are going to get hurt. Ultimately, it ends up creating, like I said before, a market for lemons in which people lose trust in the markets themselves. And a lot of investors continue to get hurt because they've simply just chosen the wrong regulatory agency to regulate it, one that doesn't have the budget to keep up with this industry.
So don't you think in the long term, it would actually at first become a boon for these kind of companies, these crypto companies, and then as a consequence of that, you would have a large part of the 401k pension, normal old school traditional financial institutions going full in on this, and then having a full capture or good percentage of retirement accounts in this at one point. What do you think happens then?
Yeah, the CFTC taking remit over the crypto industry is a great way to clear another financial crisis. Like it would be a free-for-all on a wildly manipulated market in which a bunch of pension funds would dump obscene amounts of money into these things, chasing yield, and it would end in a disaster that probably would rival the Great Depression. It would be a disaster. It's like trying to, regulate the food industry with, like securities regulation. It's a mismatch. Like these are securities contracts. They need to be regulated by the SEC.
Okay. What path do you think Congress and American regulators should take to kind of curtail the onslaught of crypto fraud and the risks to the public?
So like we discussed at this policy symposium, there's a really great talk called Are Regulations and Regulators Up to the Crypto Problem by John Reed Stark and Stephen Diehl, who were two really great professors specialized in American financial regulation. And really, the laws for crypto regulation are already on the books. They've been written in the 1930s. It's the Securities Act and the Securities Exchange Act. So crypto assets are securities, like full stop, right? So all that needs to be done is basically building the exchanges within the regulatory perimeter and enforce the same kind of common sense investor protections, disclosures, and reporting requirements on all crypto assets that securities classification entails. And once that happens, then a lot of the risks of the market become removed when exchanges can no longer trade against their own customers and front run and wash trade and engage in all the market manipulation that's been banned in markets for the last 90 years, right? Things like segregation of customer funds become the norm. Then you look at the industry and a lot of the risks get removed. It's a lot of the industry looks like the penny stock industry at that point. And but consumers are protected. And if that was the case, then I think a lot of us in the crypto skeptic space would probably say, well, okay, this looks like a risky market, but it's risk that can be managed because it's not systemic to the global economy. And it doesn't present too much of a problem anymore. And so really the need right now is just for common sense disclosures, the same investor protections we've had in markets for the last 100 years, and like standard reporting requirements on these things because they're securities, and that's the solution that we need to bring in place.
So one of the common defenses of crypto is that it's just part of some grand narrative or cycle of history, and that the manias and bubbles are justified because they inevitably lead to transformation and progress. Can you speak to these cycles, theory of history, and distinction between productive and non-productive bubbles?
Yeah, so this is one of those like arguments of last resort that I often hear from people where they're like, I agree with everything you're saying, Stephen, but like you just have to look at the grand scope of history. And like crypto just fits into this sort of, the systolic and diastolic, flow of the body politic between accumulation and redistribution. And I hear all these like fancy words about this like grand cycles of history. And I don't subscribe to this like this cyclic theory of history because I think it's overly deterministic, it's unfalsifiable, and it's not supported by rigorous evidence. It's basically a rationale that basically no matter what happens in the industry, no matter how many people get hurt, it can always be justified because history has deemed this to be the inevitable outcome. It's a philosophy I call like crypto inevitabilism. And it's kind of the argument of a psychopath. It's the argument that like no matter what damage the crypto industry does to the general public, it's always justified because this is progress and progress is always good. And having worked in software and technology in my career, I've seen so many false ends and dead ends and false starts to believe that something like crypto is inevitably good. Right, because not all technology is inevitably good. Not all innovation is unqualifiedly good. Some of it's sometimes bad. And so these arguments from these sort of grand narratives to me seem suspicious.
So Stephen, what should the role of journalism be in tackling the cryptomania?
Yeah, so journalism has a really hard role to play in kind of like what some people call the golden age of fraud, when like fraud is so ubiquitous and ever present in our lives that it's basically just a rundown of like, what is the fraud of the day? And if you look back to market manias throughout history, back in the 1700s in London, the papers at the time were running reports about like the South Sea Company being, somewhat problematic. And, it didn't stop people from speculating on the South Sea Company then. It's not stopping people from, investing in crypto now. And, I think it's a thought experiment, like, even if the Financial Times, like a really respected newspaper, ran a headline, 8 months ago saying that like, Celsius is running a financial scheme, which a lot of people are going to lose money in. The Teflon narrative of crypto just means that the true believers would just say the Financial Times, is clearly is the scam, right? They wouldn't believe it because the entire narrative of crypto is based on distrust of institutions that includes the press. They'd say, clearly, the Financial Times is like short selling Celsius or something, right? And this is the problem with reporting on fraud, is that charlatans sell you on emotion. They don't sell you on facts and logic. And your average crypto speculator is not reading the Financial Times, right? It appeals to a very kind of, crypto appeals to very base human instincts of like greed and fear, not to reasoned argument. Crypto is pure id, right? And I don't think you can take down a crypto company like Wirecard style because it's wrapped in this quasi-religious cult. And the believers really just believe that everything is a scam. And so why would this be any different? So journalists have a really hard time covering this stuff because it's hard to cover this stuff when distrust in institutions is very high, and that includes the press.
Do you think if they were covering more of the human fallout of these crypto scams and were pointing the audience towards actual regulators instead of just the general public, do you think they would be more effective?
They are reporting on the human cost of these things. It just doesn't seem to have much effect because the power of greed and money for nothing is such a strong appeal. And it may be the case that nothing will stop people from investing in these things. I don't know. It's a hard question.
Do you think a Chinese style total ban on crypto would be effective in Western democracies?
So China basically banned all crypto assets from their entire economy, and they found the right answer to the problem, but they probably did it for the wrong reasons. And a complete and outright ban may be the most expedient solution. It may result in the end state. Like if you happen to believe, like a lot of people in crypto will say, like a lot of crypto is like 98% scams, right? So, you know, if you have a bowl of M&Ms, 98% of them are poison, right? Maybe it's better just to toss out the entire bowl rather than risking it, right? And so like there's an argument to be made that if the United States were to pose all of the securities framework on top of it, it would ultimately cause 100% of the market to collapse because 98% of it is scams anyway. So maybe the most expedient way to solve this problem is basically just to ban crypto rather than wasting Congress's time for 15 months developing regulation just to, ultimately expunge what's mostly a fraudulent industry. So perhaps we just skip to the final step and avoid spending years of congressional lawmakers, going back and forth on what would be a very, very difficult law to write. And the real question is like, is there any baby to save with the bathwater? And I'm of the opinion that with the crypto industry, there's just so much bad that there's no baby to toss out with the bathwater. So might as well just flush out the bathwater. But that's only one perspective. There are other people that think otherwise.
Isn't anti-crypto sentiment just as irrational as pro-crypto sentiment?
No, because I think crypto skepticism, like the name implies, is predicated upon scientific skepticism, which is an inherent disbelief in any proposition until evidence is presented. And having worked in software, I've seen so many technologies come and go, so many dead ends, false starts, and failures that I'm skeptical about anything that makes kind of grandiose claims until I see evidence. And that's just the way we have to approach everything in life, not just crypto. Skepticism is the only rational framework that we can use to derive knowledge about the world. And I don't see crypto as either inevitable or inherently desirable a priori, like from first principles. It needs to prove itself, and there needs to be very clear, non-self-referential use cases beyond just naked speculation. And a while back, the New York Times wrote an article, is like, well, maybe there's a use case for crypto after all. And they like really, really went out of their way to try and find a single company that was not a self-referential.
Sorry, I thought you were talking about either ransomware or the company that analyzed
or crime. Okay, or crime.
Analysis.
Right. And it turns out that even the New York Times couldn't find a single one. They had to like issue a redaction based on the one company they thought was actually this like Wi-Fi sharing company. So if after 13 years, we're still asking the question, like, what is the use case of crypto? And the narrative around this technology shifts every 6 months. Maybe we should ask you some more fundamental questions. And so no, crypto skepticism is not as irrational as pro-crypto sentiment because we're based on a fundamental assumption, which is skepticism first, not inevitabilism first.
Anything else you want to say about the court case against crypto?
Yeah, if I were to summarize the court case, it's very simple. It's three things. The technology is not fit for purpose. It's based on a very poor design. A system where you lose your keys, you lose your money is not a good system. A system where transacting with anybody ultimately reveals your entire financial history and doxes you is not a good system. The economics of crypto rest on some very dubious assumptions. These are assets that have no intrinsic value. They are securities with no underlying cash flows and no income, and they're very dubious in their economics. And it appears to be a technology which has vast negative externalities, and the upside is predicated upon this sort of fantastical narrative, which seems rooted in this sort of quasi-religious story, which predicts a future which seems to not be happening. And if it all rests upon absurdities, maybe we should be asking some very deep questions about what the purpose of crypto is in the world and what we should do about it, because it seems to be more harmful than good.
Cool. Thanks, Stephen.